Let's get an outlook going for 2025. Last couple of years have been great. What is 2025 going to be like? We have Gautam Chhaochharia, Head of Global Markets India, and Tanvee Gupta Jain, Chief India Economist at UBS Securities India, joining us right here in our studios. Gautam, Tanvee, great to have both of you here. Appreciate your time. Let's just start at a very simple, basic level. It's been a good last few years, right? Actually outstanding if you look at broader markets, not measured by just the Nifty per se. 25, Gautam, are you starting with a positive skew, very positive skew, or kind of a more tepid kind of, what are enthusiasm levels like?
Well, I'll start. Thanks for having us here from UBS. Yeah. I'll start with a mix of two things. One is our EM strategist. He's still underweight India on a relative basis for 2025. If I speak to investors and then the feedback I'm getting, look, it basically boils down to policy stance and reforms agenda. India underperformed last few months largely because of the earnings miss and growth surprises, not necessarily because of India, China, and what's happening globally. Those, in our view, were small factors. The bigger factor has been the slowing growth here.
And you said policy stance.
Policy stance.
Monetary or fiscal?
Monetary and fiscal, both. And monetary also, Tanvee is the expert there, but mix of both rates as well as a liquidity stance.
And you think the slowing that we've seen in the recent months is because of that?
You could ascribe a large part of that. Again, both monetary, one of them doesn't work in itself. It has to be together. So when both of them were, in a way, slowing down or forcing growth slowdown, in totality, we saw the surprise or negative surprise to some extent in 2Q earnings or in the GDP prints.
So that gets us to Tanvee. It's all stance, both fiscal and monetary. On fiscal, there is broad agreement that government spending there's no option, but it has to pick up in the fourth quarter. Monetary, it's kind of less clear. So just your first thoughts.
Sure. So if you look at the growth momentum in India is clearly slowing. And I think early 2025 we'll get to know what is the likelihood of US imposed tariff hike on China. And that will definitely lead to more downside risk, not only for India, but as well as the global economy. So I would say India definitely needs a monetary as well as a fiscal policy support. Fiscal policy at this point, we have seen the government capex spending has been lagging. Year to date, capex is down 15%. Even if I expect that the government will be increasing the capex spend by 30% the remaining 5 months, the full year capex is only going to be 4%. So clearly, I think at this point, there is definitely a need for monetary policy support as well. We have a 75 basis point rate cut expectation starting the Feb policy of next year. Obviously, a focus will be more on how and the timing of the rate cut, especially with the weaker FX. But looking at the real policy rate in India, adjusted for the GDP deflator, at the upper quartile or the 10-year upper quartile, definitely there's a room for a rate cut in this cycle.
Okay. Hi, Tanvee as well as Gautam, and good to see you all in the studio. Thanks a lot for coming down. Well, a quick question on the current GST rates. I was speaking to a couple of experts last week, and some of them indicated maybe the government should look at lowering GST rates. That could be one of the measures. Do you agree or you don't think so?
I think in the past we have seen that if you reduce the direct tax rate, it may not have a direct impact on the economy because I can use that lowering of income tax rate to boost my savings rather than really boosting my consumption. But a cut in indirect tax rate generally tends to have a much larger impact on consumption spending because it's a tax on consumption rather than a tax on my directly income levels.
Yes.
But I would say a GST council has to decide. It is not so much to do with the government. Yeah. Eventually, the GST council has to take a call. And the GST collections have been buoyant. The tax revenue in India has been buoyant. So maybe we can look at specific products where we want some easing in the GST rates. But definitely one idea which is already going on in the market and should bode well more for consumption. Okay,
on select items, maybe some kind of a cool-off could bode well. Well, Gautam, you come in. You've given us an answer with regard to 2025. But you stop short of giving us estimated returns. 2025, which way would you be leaning? Mid-single-digit returns or high single-digit returns? Or do you think that we could brace for a difficult year, which would mean a negative year in terms of equity market returns for 2025?
Look, there are many moving parts, as always is.
But, indeed.
Even more so now, given the global backdrop of post-US elections, the policy stance there, as well as, look, there's a lot of hope building out around fiscal and monetary. And I'm less worried about what happens to FY25 GDP print and what happens to 3Q or 4Q earnings. I think that's gradually getting priced in by the market. Market knows that growth recovery, if at all, will be slow. What's critical is what scale this policy stance happens at, and therefore what's the outlook for FY26. And I think that's where it boils down to whether it's going to be a tough year or whether it was going to be a single year, double-digit year. Look, valuations in India, I'll worry less given the flows locally have remained resilient. And I don't see any reason talking to all the key clients who have these flows coming in, it's stopping anytime soon. So if the flows will remain resilient, I won't worry about valuations or necessarily market correcting in a meaningful way. Consolidation phase or single-digit, double-digit will depend, to me, boils down to policy stance and reforms agenda. And I'll not underemphasize the reforms agenda part. Look, India also has been a big reform story over the last few years, which has given hopes to market that the long-term growth in India looks exciting. That's taken a backseat along with the short-term earnings and short-term growth because elections, post-elections, now there's no election happening.
There's no excuse.
No happening for many months now. So whether we see a reforms agenda back on the table in the budget, post that, pre that, I think that also plays a role.
Since you mentioned earnings a couple of times, FY26, what are you all penciling in terms of earnings? Because FY25 is not going to be as good as what we thought at the start of the year. FY26?
Look, analyst expectations in India always is that you have a recovery next year and we go back to low double digits to high single digits. That's a broad range, depending on the sector you look at. But the question is not just that. It's what markets start believing in. If it's going to be a double-digit earnings growth, which is linked to the policy stance, I think markets will be fine. We should still expect a single-digit or even low double-digit returns.
How was 24 in terms of, I mean, so UBS now, do you have a lot of mid-cap coverage, Gautam?
Yeah,
mid-cap, small-cap? That's where the interest is, isn't it?
It still
because
is.
The larger conventional sectors, I mean, it's a bit thunder. But broader markets, it's exploding. I mean, the interest levels, activity. So just,
So look, that's a space we want to keep building our coverage on, but going back to where market interest is, clearly among the foreigners, if you go back long, many years, it used to be the big private banks, consumers, IT services, and that's what's been not performing that well in the last 2, 3, 4 years. The interest is broadened out dramatically. We all know, we spoke about industrials, etc. That's not going to change in a hurry. Even now, despite the weak earnings or earnings cuts, those sectors, the cyclical sectors, are still seeing good growth compared to the rest of the markets. So I think that's a continuing trend, and that's what we want to tap on by expanding our coverage. Even today, investors' interest, like we had a conference a month back, the foreign clients, they were more interested in looking for bottom-up ideas around the mid-cap space. So that space is continuing.
Again, it's all single stocks and individual ideas, but there are some themes from where these come from. I mean, new energy transition. I mean, these are all sort of new exciting areas. There are lots of listed opportunities which were not there 3-4 years ago. So any themes you can identify which you think one should look for? I mean, as they say, fish where the fish are. So where are the fish?
So look, the names you mentioned, nothing new for us. Those are sectors and themes we remain bullish on longer term. Our analysts, for example, industrials analyst has been downgrading a lot of names in the last 3 to 4 months, given where the valuations are, given the earnings momentum. But that's a space to be in. Industrials, cyclicals, capex, specialty chemicals. The sectors where we are not so convinced yet at a broader level is pharmaceuticals, where we see very select opportunities, but broadly we see headwinds. The renewable space looks very exciting, very exciting. There's a lot more which can happen versus what's been announced. And we're already only seeing the early stage, you would say, of the listed universe participating in that in a big way.
When you say renewables, what part of the renewables chain?
The entire value chain, from utilities to suppliers to EPC companies. And we've seen the playbook happen in China last many years. It's early stage in India.
Is it driven by protection, though, a lot of it?
Look,
I mean, not right or wrong, but I'm just saying.
Forget right or wrong, but protection is also in the context of what's happening globally. If it's protection happening only in India, then it would be a worry from a longer term.
It's happening everywhere. So
if it happens everywhere, then it's possibly feasible.
Okay, all right. Tanvee, you come in on this. You know, we've got a new RBI coming up. Mr. Malhotra takes over from Mr. Das. Some would have argued that maybe, he should have got an extension of, say, a year or so. The bigger problem is the vice captain, so to call it, Mr. Patra as well, could be moving out. How do you see, the new governor in terms of a stance, continuity, as well as the key focal points that he'll have?
Sure, this is not the first time we are having a bureaucrat turned banker.
Indeed.
We did see Mr. Das have a exceptionally good tenure, and he was able to ensure that RBI's autonomy is managed, and at the same time was able to very strongly manage the relationship between the RBI and the government, something which we had not seen in the past, and there were always a lot of frictions which were out there. So we are more hopeful that even the new RBI governor will be on the same path. Irrespective of the RBI governor, our call is still the same, that the inflation is going to soften pretty sharply. We are already seeing the number going down from 6.2% last month to 5.5% in the month of November. Our forecasts are saying that the inflation will be softening towards 4.5% by the month of March.
Okay.
So clearly inflation is softening. Growth is showing signs of slowdown, even though we do see some cyclical pickup in the second half, largely because of festive season demand, good monsoons now finally having impact on the rural sentiment, which were yet to be seen. And we are hopeful that the government capex spending will be picking up, even though it is going to fall short of the target. But I would say, irrespective of the RBI governor, we are maintaining our call that the policy stance as well as the rate cut cycle is going to start in India. The question is on the quantum of rate cut. How much opportunity will India have to cut rates, especially when we will see the new Trump administration resuming office in Jan, and what it means for the tariff hikes on China. I mean, that is all in the media. So our US team is expecting that 75% of China's goods get taxed at 60% from the September quarter. Okay. In case we do see any preponement of tariff hike, then I think the ability for RBI to cut rates will also get limited. So as of now, we are still having a 75 basis point rate cut, assuming Trump-related tariff hike only come into picture from the September quarter.
Sorry, you said 60%?
60%.
Yes.
China imports into the US.
Yes.
Right, on Chinese goods.
75% of China's goods get taxed at 60% in 4 tranches.
60% is what he said. Well, everyone assumes that it won't be 60, it'll be, that's just a starting gambit.
We still have that 60% tariff hike in our forecast. Wow. And that's why we reduced and lowered India's GDP growth to 6.3%.
Because, I mean, the general consensus view is that it's all China. It doesn't have any other impact. India is insulated. But it rarely ever works like that, right? I mean, there are second order, third order sort of implications, and it feeds through eventually.
Absolutely. So there are 3 ways India can get affected. One is a global growth slowdown, largely because of fading China as well as the US growth. And when US growth has been very strong so far. So India is a low beta economy, but India is not immune. So India will get affected indirectly. Second, the biggest risk, I think why we are downgraded India's GDP growth forecast for next year is that the private corporate capex recovery, which has been concentrated in a very narrow part of corporate India, might get further delayed and pushed out. If I'm a corporate, I would have, I always have that option of buying a cheaper import from China, especially when China has excess capacity to offload. And third, and I think the market is not discounting the fact what happens to RMB, because if you compare with 2018-19, RMB depreciated by 13%. INA is going to appreciate against RMB. It makes a lot more sense. If I'm an Indian corporate, why not I import from China rather than expanding domestic investment in India? So I would say...
What's your rupee forecast? You think we're headed to...
We are actually expecting rupee to gradually depreciate towards 87. This is based on a 5% RMB depreciation, what my US and China team are forecasting.
It has to be, right, to stay competitive. It has to, I mean, join to the hip in that sense.
Yes.
Tell me just one point. Government stimulus will do the job, and we need both monetary and fiscal. But just there's an underlying worry, and this is a minority view, that maybe growth has now come back to levels where we were before COVID hit. I mean, that quarter, right? So you were actually, you had this big COVID sugar rush after COVID. I mean, spending really boomed, and the top end really prospered and made money. And if people, especially who held stock, I mean, they made a lot of money, and it went everywhere. And now all that is kind of fizzling away, and you're coming back to trend growth. I hope that is not true. No, absolutely not. I'm not of that camp, because I think the macro stability risk has improved dramatically since the COVID-19, before even the COVID-19 shock. Your balance sheet is much stronger. Corporates have used COVID as an opportunity to deleverage. Asset quality of banks, despite that massive credit boom we have seen, is still very much, or I think one of the best we have seen in 10 years. Right. Before the COVID pandemic happened, the growth slowdown was also partly because of NBFC crisis related after effect. I don't see much of an impact right now. So I think India is in a much stronger, much better position than what we were pre-pandemic. So definitely, I think the trend growth is more towards 6.5. That time we had reduced our trend growth to more towards 5.5, 6. So clearly, we are much better than what we were in 2019. Tanvee and Gautam, stay with us. What we're going to do is take a quick commercial break here, and we're going to come back, continue the conversation with the top UBS India team.